Welcome back to Smart Stock Sam. There's big news on this stock recently, and market is reacting as expected. But let's slow down and focus on the facts and see how they are shaping the narrative. I'll cover what's real, what's noise, and what it could mean next. For quick updates like this, subscribe and tap the bell to catch every market move on time. All right, here we go. Is AMC Entertainment finally dead? Or is the mother of all short squeezes about to blindside Wall Street? Today is Tuesday, January 13th, 2026. And we are witnessing one of the most confusing tug-of-wars in market history. Yesterday, AMC shares managed to claw back 7%, closing at $1.73. But while retail investors are celebrating this dead cat bounce, Citigroup just dropped a nuclear bomb on the stock, slashing their price target to a terrifying $1.30. Why is Wall Street betting on a total collapse just as Avatar and Stranger Things are breaking records? And why is everyone talking about a February trap that could wipe out every gain we've made this week? In the next 10 minutes, we are breaking down the 3 shocking reasons behind the 110% spike in call options, and the exact date in February that could either launch this stock to the moon or send it straight to zero. If you have a single share of AMC, you cannot afford to miss this data. Let's dive in. Let's look at the cold, hard numbers. As of today, January 13th, the stock is sitting at $1.73. Yes, we've seen a 5.5 to 7% rebound from the all-time lows we hit earlier this month. But don't let that small green candle fool you. When we zoom out, the technical are screaming danger. AMC is currently trading well below its 200-day moving average of $2.73 and its 50-day moving average of $2.08. In fact, over the last 12 months, the stock has bled out more than 50% of its value. But here's the kicker. Even with that downward pressure, retail sentiment hasn't broken. Traders just purchased an unusually large volume of call options, up 110% over typical levels. This tells us that the apes are betting on a massive bottom. They aren't just holding, they are loading up for a squeeze. But are they running headfirst into a wall? While retail is buying calls, Wall Street is sharpening its knives. Yesterday, January 12th, Citigroup analyst Jason Bazinet sent shockwaves through the market. He maintained his sell rating, but significantly lowered his price target from $2.30 all the way down to $1.30. Think about that. Citigroup believes this stock has another 25% to drop from its current levels. Why? It all comes down to the debt monster. AMC is currently lugging around $8 billion in debt, with $81 negative free cash flow and a $298 net loss. Bazinet's report suggests that in this challenging financial environment, the company simply isn't making enough to keep its head above water. While the consensus target is still technically around $3.08, the trend is clear. The smart money is revising their numbers downward, and they are doing it fast. Now, let's look at the silver lining, because it's not all bad news. Operationally, AMC is actually crushing it. Avatar just grossed a massive $1 billion worldwide. And that collaboration with Netflix for the Stranger Things series finale? It was a masterstroke. They brought over 750,000 fans into theaters in just 2 days. People want to go to the movies. In the most recent quarter, AMC reported revenue of $1.3 billion, actually beating expectations. But here is the shocking statement you need to hear. Despite making $1.3 billion, the company still reported a net loss of approximately $298 million. Think about that. They had a record-breaking movie and a viral Netflix event, and they still lost nearly $300 million in a single quarter. This highlights the persistent struggle to reach consistent profitability while servicing that massive debt. This brings us to the February trap. If you are wondering why the stock hit record lows recently, this is it. AMC has an amended note agreement that officially allows them to begin at the market equity offerings of up to $150 million starting in February 2026. For those who don't speak Wall Street, that means more share dilution. Every time the stock tries to rally, the company has the power to drop more shares into the market to raise cash. This potential for dilution is the primary driver behind the recent decline. Investors are terrified that as soon as the stock hits $2, the company will hit the sell button to pay down that $8 billion debt. Are we being used as exit liquidity for the company's debt management? So, what is the final verdict for January 13th, 2026? We are in a pressure cooker phase. On one side, you have record-breaking attendance and a 110% spike in call options. On the other, you have a $1.30 price target from Citigroup and a $150 million dilution window opening in just a few weeks. Looking at the chart behavior, the $1.73 level is a temporary relief zone. The line in the sand is the 50-day moving average at $2.08. Until AMC can close above $2.08 on high volume, this is still a bearish trend. If we can't break $1.90 this week, the gravity of that $1.30 Citigroup target might become a reality, especially as we head towards the Q4 earnings report in February. That earnings call will be the make-or-break moment for the 2026 film slate. Trade plan is to watch the volume. If we see another spike in calls without a corresponding drop in price, the squeeze might have legs. But if that $150 million dilution hits in February, all bets are off. What do you think? Is the $1.30 target a lie, or is the February trap real? Drop your price target in the comments below. All right, that's the update. If you want more quick fact-based insight like this, subscribe and tap the bell icon so you don't miss the next one. Drop your thoughts in the comments, and I'll see you in the next update on Smart Stock Sam.